Have you ever been researching a down payment assistance program or just starting your journey and saw all of these abbreviations and mortgage terms and thought, what does this even mean? Things like LTV, DTI, APR. The mortgage world is full of a lot of different abbreviations and terms that can be overwhelming if you don't use them every day. But here's the truth. Once you understand them and the basics, you'll feel a lot more confident and less stressed when you're looking to purchase your first home or refinance. Today, I'm going to break down 5 very common mortgage terms, what they mean, and why they matter. So grab a notebook if you'd like, because you're going to want to keep these in your back pocket. Let's dive into it. First, let's dive into LTV. The LTV stands for the loan to value ratio. This is a number that lenders use to determine how much you are borrowing versus the value of your home. What's interesting about this abbreviation is that it's also a mathematical equation. So for LTV, the loan to value, we take the loan amount and we divide it into the value of the home, and that gives us a percentage. So for example, if we use a value of $400,000 and a loan amount of $320,000, the loan, $320,000, divided into $400,000 is 80%. This means that the loan is being lent at 80% loan to value and that there's 20% equity remaining in the property. Why does the LTV matter? Well, it impacts things like the loan options and the rate made available to you, in addition to credit score and property type, but mainly whether or not you're going to need mortgage insurance. Mortgage insurance is required on conventional loans when you have less than 20% equity in the property, or your loan to value is higher than 80%. Generally, the lower the loan to value, the stronger the loan profile can look when your loan is being underwritten. So if you ever wondered why your friend or neighbor may have gotten a slightly different rate than you did, then it's very possible that it could have been because their LTV. Next up is the DTI, or the debt to income ratio. This is how lenders determine your ability to manage your monthly payments. And you may have guessed it, it is also a mathematical equation. So, depending on what type of debt and income we are analyzing, will give us the debt to income ratio. And we take that total debt and we divide it into the amount of qualifying income, and it gives us a percentage. Now, with debt to income ratios, there's 2 types. There's a front end debt to income ratio, and there's a back end debt to income ratio. And when you generally hear a lender saying, oh, we need to keep things at 43% or 50%, those are usually referring to the back end DTI. So what's the difference? The front end is only taking the housing costs into account. And you may have heard another term called PITI or PITIA. This is the total loan, the principal and interest, your taxes and your insurance, and then whether or not there's any HOA dues. So we take that entire total and we divide that into the gross qualifying income, and that will give us the front DTI ratio. Now, for the back end or the total DTI, we take that housing number, but also whatever monthly payments are showing up on your credit report, as well as anything else that might not, but is important. And that would be things like an IRS or state tax payment plan, child support or alimony. And we take all of those and put it together and divide that into the gross qualifying income. And that gives us that back end DTI or the total DTI. So when we're looking at pre-qualifying and using vague numbers, let's say that someone is making $10,000 gross monthly income. So this is that number before any taxes are taken out. And we need to make sure that our DTI is at or under 50%. So we take that total number, $10,000, take 50% of that number, $5,000, and that tells us that, hey, from the housing payment total and everything else showing up on the credit report and anything else we might need to consider in the guidelines, everything needs to be at $5,000 or less. So if we have a client that has their car payment, student loans, credit cards, and all those other things total $1,500, then that means that we have to make sure and restructure the numbers so that their total housing payment is no more than $3,500 a month. So why does this matter? The DTI is important to a lender because they want to make sure that you can comfortably manage the housing payment. No lender ever wants to lend you that loan to purchase a home and then have you foreclose on it because the numbers were just too tight for your budget. So they just want to make sure that you can comfortably afford it and that homeownership is going to be a benefit and not a burden. Next is the APR, and this one is for the annual percentage rate. And it actually trips up a lot of people because it can be misunderstood for the actual interest rate, but they are different. So here's how it works. The interest rate itself is what you are charged and what is going to be the cost on a monthly basis for borrowing that money. But the APR is much more involved. It takes into account not only that interest rate, but other costs as well. Things like the loan costs, points, and other fees. And then it takes this and it amortizes it over the life of the loan. So if you have a 30-year loan, it will look at that over a 30-year loan and then translate that to a percentage for the actual cost of that if you were to keep it for the entirety of that loan term. So why does this matter? Well, this is important when you're thinking about refinancing and potentially having another refinance in the future, because most homeowners don't keep the loan that they're currently in for more than 5 to 7 years, whether they're going to refinance or move. If you do refinance or sell, then you won't pay the cost the way that the APR assumes. In fact, the shorter you keep the loan, the less meaningful the APR is, and the more impactful the actual interest rate and upfront costs are for that loan. So think of APR as a tool to compare two different quotes side by side, but always keep in mind that it only tells the full picture if you're going to keep the loan for the entirety of that loan term. Now let's talk about cash to close. This is a total amount of money that you will need to bring to the closing table. It includes your down payment, your closing costs, and any prepaid expenses like homeowners insurance and property taxes. I actually like to call this the all-in investment because in the mortgage world, the term cash can actually be misleading. Rather than having actual cash as your initial earnest money deposit or bringing in for your final funds, you will be wiring these funds in most cases. Why does this term matter? It's important because when I have initial conversations, especially with first-time home buyers, a lot of times they're currently saving for the down payment and they don't consider the other closing costs and fees involved in obtaining the loan. So it's important to know the all-in investment number that you will need, which is in addition to your down payment. And finally, another important term to know is escrow or impound account. And these words are used synonymously. But think of it like an internal savings account that the lender manages on your behalf. Each month, part of your mortgage payment goes into this account. So the lender looks at what is the annual cost of things like your property taxes or your home insurance, and then divides that by 12. And when those bills come due each year, the lender will use the funds in your impound or escrow account to pay those bills for you. Here's what you need to know. Your escrow account may include your property taxes and or your insurance, depending on how it's set up. At closing, the amount collected to put initially into that account will be based on when those next bills are actually due. So the closer that we are to that deadline, the higher that those prorations will be. On a purchase, home insurance is always required to pay that first year up front. And on a refinance, it will have to be paid if that renewal premium is due within the next 60 days. And what's interesting is that during the life of the loan, it's the escrow account that can actually impact the monthly payment changes that happen. Because if you are in a fixed rate mortgage loan, for example, like a 30-year fixed, but your payment is changing, well, it's not the interest rate or the loan terms that are changing. It's the other things that are impacting that total payment, like insurance and property taxes. So as those adjust annually, the mortgage payment that's paid to the lender will also adjust. And here's something else about the escrow and impound accounts that a lot of people don't realize. They're most of the time optional. They're always required on FHA loans, so there's no way around that. But on conventional loans, most lenders will tell you that they're optional unless you have at least 10% equity in the property. But I work with lenders that allow borrowers to have impounds being optional when there's just at least 5% equity in the property. Now, same thing for VA loans. VA doesn't require impounds, but there's a lot of lenders that will have an overlay that say that they are required. You might be wondering, why would someone want to have them as optional and not have your property taxes and insurance included in your mortgage payment? While having impounds are very popular and usually occurs in most cases, I find that borrowers who have incomes where it's not the same every single month, so they may have a particular base and they may get commissioned, or if they're self employed and the income fluctuates, having that lower monthly payment of just paying the loan payment and then having that flexibility to pay the homeowner's insurance and the property taxes as they're due allows them to tuck away those bonuses or commission incomes throughout the year to pay those upcoming bills, but allows them to then have that lower payment on a monthly basis. Now, waiving impounds is not a good fit for everyone, and sometimes folks feel a lot more secure when they are included, and that's fine too. But it's all about being able to give the options and allowing the borrower to find the best decision for their situation. Well, I hope you found this information helpful. And if you did, I would love it if you liked the video, subscribed, and shared it with a friend. My name is Amber Jones. I'm a certified mortgage advisor, and I'm here to help inform you, empower you, and help you solve that financial obstacle you're currently facing on your homeownership journey. I would love to help answer any questions that you may have about these terms or anything else about getting qualified for a loan. All of my contact information is below, where you can book a 15-minute phone consultation with me, and we can get started from there. I hope you have a great rest of your day, and I'll see you again next time. Bye-bye.